If you are getting a big refund though, I would call that more of a yellow flag. That means that things changed and you kind of missed out on a good amount of cash flow either in your personal household or in the business. So the times that you might get a big refund is if you had really a gangbuster year for the business where things went really well and your income went way up. And then after that, maybe you have a lackluster year. So income went down, but you paid the estimates based on the prior year. You didn't start your practice to barely hang on. I'll guess you started it for freedom, impact, and profit. This is Therapy for Your Money. I'm your host, Julie Harris. I'm an accountant, author of Profit First for Therapists, and CEO of Green Oak Accounting. Over the years, my team and I have partnered with hundreds of private practice owners, whether they're just getting started, scaling into thriving groups, or even preparing to sell. We've seen it all, and we know exactly what makes a practice tick financially. On Therapy for Your Money, I'll help you build a business that truly works for you. You'll get quick, actionable tips and episodes so that you can grow a profitable practice, increase your financial confidence, and pay yourself unapologetically. Because your work is way too important for you to burn out or go broke doing it. Love the podcast? Make sure to follow and give us a 5-star review. Here is Therapy for Your Money. Hello, and welcome to Therapy for Your Money. This is the first episode of the new year, so I thought we would start off with a tax topic. Today we are talking about if getting a tax refund is a good thing or a not so good thing. Most people, when they get a tax refund, they're like, oh yeah, this is great. I got my tax refund. Right? It feels like a bonus or free money. But for business owners, a refund isn't always necessarily a good thing. So I want to talk about kind of green flag items, yellow flag, like something might be up, and then red flag where we do not want this to be happening. So we're going to talk about the gamut of them today. Okay, so first of all, a refund from the IRS or from the state is really, that means that you gave the IRS a free loan, right? An interest-free loan. That means that you have paid too much in and then you are getting some funds back. Now, for a lot of small business owners, they're often not even getting a full refund. Sometimes they are, but often they are just even applying that to next year's tax, right? So sometimes it does make sense to overpay a little bit and then you'll just apply it to your first quarter estimates. It's not a big deal. When in doubt, I'd rather you pay just a little bit more than not quite enough, because in a business owner's life, like that amount can fluctuate pretty significantly. If you're having a great year, you might owe a lot more. And if you're having a less good year, then things can change. But sometimes if you can pay the full amount that is due, you want to pay that. So really, you get a green flag if you're getting a small refund. And I would say like a few hundred to a couple $1,000s. I would consider that for a small business owner to be a small refund, because your quarterly estimates are just that, they're an estimate, right? We don't actually know what's going to happen, during the year. And so we estimate it as your accountant. You might estimate it as a business owner. And so it's normal for it to not be 100% accurate, right? Like owing a little bit or having a little bit back, not a problem. That is a green flag. If you have a spouse, for example, that's a high income earner, maybe their withholding was a little bit high, then great. You got a little bit of a refund, not a big deal. You may want to look at their W-4. But again, just might be a little bit better to pay a little too much than not quite enough. You get a green flag there. If you are getting a big refund though, I would call that more of a yellow flag. That means that things changed and you kind of missed out on a good amount of cash flow either in your personal household or in the business. So the times that you might get a big refund is if you had really a gangbuster year for the business where things went really well and your income went way up. And then after that, maybe you have a lackluster year. So income went down, but you paid the estimates based on the prior year, right? So let's just break that down for a second, how quarterly estimated tax works. In the current year, let's just say you're listening to this in January 2026, right? So when your quarterly estimates are due in April, June, September, and then following January, we don't actually know what's going to happen yet, right? Even when your accountant finalizes your tax return in March, it's only March. We don't actually know how the year is going to end up. So your quarterly estimated tax payments that they give you, they're based on last year's tax. they're either 100 or 110% of last year's tax, because that is the known item. We know what that was once that tax return is filed. We know. And so if things change significantly, right, let's say 2026 ends up being not as great of a year as 2025, then your estimates are still based on last year's tax. So you may actually be overpaying. So if you end up with a big refund, that usually means you had a great year and a not so great year, and you didn't adjust in between. So some of the things that you can do there is, if you are working with a tax accountant, let's say you get to August, September, October of this year, and you think like, oh, if I'm looking at my profit and loss for this year compared to last year, we're not quite where we were. We are farther behind. It's a great time to have a conversation with your accountant and say, hey, do I need to look at updating my estimates for third quarter and fourth quarter? Because you can do that. And sometimes you should do that, right? So for example, for us, sometimes we'll have our clients maybe do the full third quarter payment, but skip the fourth quarter payment, because then we can look at those numbers again in November once October is closed and just get a better idea of where we think the year is going to end. Still very much a forecast, right? Something crazy could happen, but it gives us a better idea of where things are. Or we might say, if cash flow is affected, maybe we want to reduce slightly the third quarter and the fourth quarter payment to allow for a more even cash flow. That is okay. But it can be a good idea to make those changes if you need the money in the practice, right? If the practice is not doing quite as well as the prior year, there's a good chance that you might actually not have the full amount you need to make that tax payment in full, and that you might have better uses for the funds inside the practice. And so that's where having that relationship with your accountant and looking at what's going on and what can we adjust, that can be a really, really, really good thing. Okay. A couple of things I want you to think about if you have a bigger than expected refund is why. Why did this happen? There's a lot of different reasons, but I want you to know and understand why, so that you can then put your business owner hat on and think about, does this make sense? Is there something I need to course correct and do differently? Let's look at some red flags when it comes to a big tax refund. And really, dollar amount matters here, and it's going to be relative to each practice, right? But you're going to know what's little for you and what's big for your practice. So for example, a solo practice, getting a $5,000 refund might feel big, but for a large group practice, getting a $100,000 refund might be big, right? So it's all relative. But when you are getting a larger than expected amount, I want the alarm bells to be going off in your head. And specifically, if you get a check that you were not expecting from the IRS or from the state, that is a large amount, I definitely want the alarm bells to be going off in your head, because I'm going to call that a red flag. There's a couple of different things that could be going wrong, and I want you to know about them. Specifically, there may be a payroll tax issue, okay? So that check is still going to come from the Treasury Department. And it might actually not say what it is for, but I want you to do some digging if you get a large check. So sometimes there could be a 941 issue, which is the quarterly form that you file, your payroll provider files every quarter. Sometimes if you are doing a payroll conversion, maybe you're going from one provider to another, things can get lost, things can be doubled up, or things can be done incorrectly. And sometimes that's when you'll get an unexpected check. And if you cash that check and you don't say anything to your accountant, you might end up having to write a check for that to go right back out. But if you've already spent that money, ooh, that does not feel good. So if you're getting something that you do not expect, I would always just run it by your accountant to say like, hey, I got this check. Here's the letter that came with it. If there is a letter, sometimes the check and the letter will come separately, so that they can put eyes on it and say like, wait a second, something is up here. Another thing that can happen is sometimes an EIN situation, right? I've seen it happen before where the payroll is being run by the wrong EIN, and then the payment is being made by a different EIN. And so the IRS is saying like, oh, wait, you don't owe us anything, so I'm just going to send the money right back. It just wasn't applied to the wrong EIN, to the right EIN. And so that's a big deal, right? You want to know what's going on, and you want to correct it as soon as possible. You want to be able to do something about it. Sometimes it is a quarterly estimated tax payment that maybe was applied to the wrong social security number, right? And so they're sending you the money back thinking like, oh, you don't owe this, but it just was applied incorrectly. Specifically, that happens often with spouses where maybe the one spouse is the first taxpayer on the tax return and the second spouse is making a payment and it's not being applied correctly, right? The IRS systems are very, very old. They're not sophisticated. They apply things wrong all the time. It's very fixable, but you have to do something about it, right? Usually you just have to call, or your accountant is going to call and have them apply the payment to the right spot. But specifically, there's a lot of payroll related things that can go wrong, and you don't want to let that drag on because eventually they usually will figure out what the problem was and then ask for the money back with interest, right? Because that money actually was owed at a prior time. But we specifically see payroll issues happen when you're moving from one payroll provider to the other. Sometimes there's some confusion on which provider is going to be filing the end of quarter report. So one provider may file one that's incomplete because like some of the payroll is on a different provider. And then when they try to file the report, it just bounces because something has already been filed, right? Again, these systems are very antiquated. And so it can happen. If the report bounces, they think you owe just a smaller amount. They're going to send you that money back, but it's not really yours. And withholding from your team member is considered a trust fund, and those penalties are really large. That's not your money. It never was your money, right? It's payroll money that really should have been your employees, was withheld, that you're required to pay to the government. That money is not yours. So you want to make sure that it is applied correctly. So if that happens, definitely take a picture or scan, send it to your accountant, have them look into what is going on. There are a couple of other kind of weird situations that might come up. Sometimes you'll get a state's income tax or unemployment tax or franchise tax refund that is surprising you. Sometimes it is nothing. Sometimes it is something. Maybe you had the wrong unemployment rate in your payroll system. And so they're sending you a big refund because they just noticed a couple of years later. Like I've seen that happen actually multiple times in my career where it was just the wrong percentage, right? The wrong rate in the system. And so a client will get a $3,000 check a few years later because they overpaid. That's great. I mean, that's a nice surprise, but you definitely want to make sure that you know what's going on before you cash that check. It might be something was misreported in the prior year. It's just worth knowing, understanding what it is for before you cash the check. It's always just having someone who's on your side who understands all this stuff, who can decipher what is going on and who can play detective is just really, really helpful. Ultimately, when you do get a tax refund, I think it can be a good thing. You can celebrate. It's kind of a nice little windfall. But do think about, put on your detective hat, what is going on, enlist the help of your accountant to make sure that you don't actually owe this money. Have a conversation with them on whether you should adjust things for the future or not. When you have a good payroll system that's going to help avoid a lot of these problems, when you have an accountant or you do your bookkeeping on a regular basis, that is also going to help you see when things just aren't quite right. And having good systems around like how money is paid to these agencies, right? They're not optional. So hopefully all of that is done with your quarterly estimated taxes, with your payroll provider, and that there are systems around that. But just double check that everything is happening on the way that it should be. And if you get something that you are not expecting, get curious. That's all for today. I hope you have a great day and a wonderful start to the new year. Take care. That's it for today's episode of Therapy for Your Money. Catch us on Instagram and Facebook at Therapy for Your Money Podcast. And don't forget to subscribe to Green Oak Accounting on YouTube. Until next time.
The information contained in this podcast represents the host and guest's general opinions and should not be construed as personalized accounting and tax advice. Listeners should consider all facts and circumstances before applying this information and seek appropriate advice from an accountant, financial planner, lawyer, or other professional. Any info provided does not constitute accounting, tax, or legal advice.